Bitcoin whales know what's coming next. The market looks rough right now. I know charts are bleeding, sentiment is flat, and everyone's wondering if the rally already peaked and if the bull run is over. Now, if you know me, you know what I think. I don't think it's over, but I know it feels heavy out there. You can feel the kind of exhaustion that usually shows up near the end of a correction. Gold broke hard, the dollar is spiking, and risk assets across the board are struggling to find a floor. But here is what is strange, and here's what I want to talk about. While traders are panicking and headlines are screaming weakness, you already know we should not pay attention to what we see in headlines. For the most part, we see that Bitcoin's behavior isn't matching the fear. And deep beneath the noise, there's a shift happening that almost nobody is talking about. Because even as prices slide, the biggest holders in the space are quietly doing something that tells a completely different story. So stay with me, because by the end of today's video, we'll be looking at what the data is really telling us, what it's revealing, and why, most importantly, some of the smartest investors in the world, smart money, seem to be playing an entirely different game, and how maybe so should we. Okay, so getting started, we see that the Federal Reserve just made a decision that changes the system itself. We see that Governor Christopher Waller announced a new skinny master account model, which is a framework that will let fintech and crypto companies connect directly to the Fed's payment rails. For decades, those rails were closed. Only banks could move dollars through them. But now we see that digital asset firms could have the same limited access to the same infrastructure that clears trillions of dollars daily. It sounds technical, but this is huge. This is the first real opening between the central bank and the crypto ecosystem. It's a step toward merging digital finance with the US monetary system itself. And the timing could not be more perfect or interesting, because as the Fed opens its doors, the biggest names in crypto are walking straight into Congress. We're seeing executives from Coinbase, Galaxy Digital, Kraken, Chainlink, Uniswap, Circle, Ripple, Solana, and Paradigm. They are all on Capitol Hill this week, and they're meeting with Senate Republicans and Democrats to push one goal, and that is to finish digital asset market structure legislation before midterms. And at 10 a.m., Trump's crypto and AI czar or lead, David Sachs, met with the Senate Banking Committee to deliver a message straight from the White House, which show us digital asset legislation is still a priority. And at 11:30, Senator Kristen Gillibrand hosted a Democratic roundtable with Chuck Schumer, Cory Booker, and others. We also see that Brian Armstrong, Mike Novogratz, Sergey Nazarov, Hayden Adams, everyone is in one building shaping the next chapter of regulation. So maybe the charts don't show this, but it doesn't matter. There's always a delay, and what is happening is so huge, it will have an impact on the market, on the token price, and on the bull run and how long it lasts, which I believe may be ongoing indefinitely and will just look different with some ups and downs as we're seeing today. Anyway, while they were talking about building the framework for crypto regulation, one company was already 3 steps ahead, quietly constructing the market they're still trying to define. And that is Coinbase. Coinbase is building the next Wall Street, guys. We see that they just dropped $375 million to acquire a private on-chain investment platform called Echo, which is a company created by Kobe, one of the crypto's earliest influencers. And on paper, it may just look like a simple acquisition, but in reality, it's a blueprint for something much bigger, what analysts are calling Internet Capital Markets, or ICM for short. And it's the idea of turning the entire process of raising money, investing, and trading ownership into something that happens entirely on chain. No middlemen, no clearinghouses, just code, users, and liquidity. It's going to be global from day one. And tell me yes or no if this is not the future being built right now in real time. For years, this concept floated around Solana circles, more so a dream than execution, though. But now, Coinbase has the reach, it has the licenses and the tech stack to make it real and make it happen. And with Base, we know its own layer 2 network, they can connect more than 100 million users to private deals, tokenized equity, and new financial products that never touch traditional rails. You can call it what you want, but this could be the first real bridge between American retail investors and early stage Web3 investing. And if we take a look at liquidity and crypto, we see it now has its own engine. For instance, Tether's USDT just surpassed 500 million users and $182 billion in circulating supply. That's 6% of the global population using a crypto denominated dollar. And in countries battling inflation or currency controls, USDT has become the bridge to global commerce, the dollar on rails that anyone can use. So while the Fed experiments with policy, Tether has already built a parallel system at scale. And this flood of stablecoin demand is the backbone for everything else. We're talking about the liquidity pool feeding ETFs, on-chain loans, and eventually Bitcoin itself. And we know every cycle leaves footprints. And right now, they're showing up on chain. New data from bbterminal.com reveals a sharp rise in wallets holding over 100 Bitcoin. That number hasn't moved like this since early 2016 and again in 2020. And both times right before Bitcoin took off into full-blown price discovery. So even with Bitcoin trading at near record highs, these wallets are growing fast. So this means the deepest pockets in crypto, okay, the richest people with the most holdings, which essentially are the family offices, miners, and long-term holders, they are quietly adding to their stacks while the market hesitates. Why? Because they know better. They are smart investors. And this is why I say again and again, we cannot pay attention to what we see in the news or even all the time what we see in the price. We have to pay attention and follow closely after the smart investors. And it's the same pattern that's played out in every major bull run phase in the past. One where we've seen accumulation in silence, disbelief at the start, and then a flood of capital once the move is already underway. Except this time, the whales are not just traders. We're talking about institutions converting billions into regulated ETF exposure and corporate treasuries diversifying through crypto rails. So you see something big is happening, and on-chain data always catches it first, which is the beauty of crypto. And if we go take a look at what these whales, okay, the new whales, the new smart money participating with us here in the crypto market, if we go take a look at what they're doing and what the data says, we see that Galaxy Digital, for instance, that's also in Congress today and this week, just posted its strongest quarter in 8 years, 505 million in net income and 629 million in adjusted EBITDA. And we see their trading, lending, and custody businesses hit record highs too. They tokenized their own Class A stock on Solana. They launched Galaxy One to unify cash, crypto, and equities in a single app, and secured funding for 133 megawatts of AI-driven data center capacity coming online next year in 2026. So that's a real business proving that crypto infrastructure now produces real profit. You can see the pattern forming, whales accumulating first, institutions following, and the data always confirming it after the fact. And ETF inflows tell us the same story. Spot Bitcoin ETFs pulled in 477 million in one day, with most of it going into BlackRock and ARK Invest funds. Gold, meanwhile, lost more than $1 trillion in market value overnight. Capital, we see, is rotating from static assets into digital ones, exactly as we have been foresaying or foretelling here on my channel. And actually, most real thought leaders know this too. But okay, let's keep moving on, because we also see that Standard Chartered just raised its year-end Bitcoin forecast to $200,000, citing ETF inflows, tariff volatility, and easing monetary policy. So we see everything, macro policy, institutional capital, and infrastructure are all aligning again just like it did before the 2020 melt-up. So in closing, guys, just remember the Federal Reserve is opening its rails. Congress is writing crypto law this week with industry leaders at the table. And we see Coinbase and Galaxy are merging finance with blockchain, Tether already connecting 500 million users to the dollar. And most importantly, I would say, we see whales, those we should model our actions after. They are not scared, right? They are quietly positioning themselves ahead of the next liquidity wave. They are buying now, which is how you make money in investing. You buy it cheaper on the front end so that when it pumps, you already made profit. You want to make profit in the beginning, actually, as you buy, because things are discounted. And that's what whales and smart money know, and something we too should practice. So you should not be scared during these times. You should be wise, but not scared. And as we wrap things up, just remember that we're seeing the same alignment that we saw in 2020's cycle. Only this time it's larger, it's faster, there are bigger players involved, and Web3 crypto tech is penetrating deeper into the system itself. This is the moment before the ignition, so stay early, stay liquid. I love you guys so much. That is it for today's video, and I will catch you in my video here tomorrow.